Hi guys, I'm doing a video today rather than writing up a blog simply because I'm talking about the S&Ps. There'll be quite a few charts and it'll be easier to do a blog via video than by writing it out in longhand. Whenever I'm looking for a trade, the first thing I do is look for the context and look to answer the question, in my trader's time frame, is the trend likely to continue or change? So let's have a look at that first off. Here we're looking at the four indices of the S&P, of the US stocks, and you see you've got the Dow on the left, you've got the Nasdaq on the right, and below the Dow is the S&P, and below the Nasdaq is the Russell. Now the red lines represent the 18-day swing, which is my trader's time frame, and the dashed lines that you see on the Dow and the S&P represent what I call invisible swings. Now I'm not going to go into it here, just suffice to say that for all intents and purposes those things represent swing highs and lows for the 18-day swing as far as the Dow and the S&P are concerned. A bit of context, both in all the instruments, the what I call the 13W line turned down, and then some of them in the Dow and the S&P, they haven't turned up, but they have turned up for the Nasdaq and the Russell. So what does that mean? Well, it means that the Dow and the S&P and the Nasdaq and the Russell were in an uptrend. Then when the line for the 13W, which is the quarterly, turned down, the 18-day trend, which is the monthly trend, turned down with it. So for all the four indices, the trend went from up to down as far as I'm concerned. Subsequently, the Nasdaq and the Russell broke to the upside, turning the trend from down to up, and the Dow and the S&Ps are still in a downtrend, with the S&P threatening at this stage either to break to the upside or give you what I call a repo sell signal. A repo sell signal takes place where you have the trend below the current dominant trend, which is the 13W, at a previous high. Market breaks to new highs, has very contracted ranges, and then sells off sharply. That's what we've got on the S&Ps at the moment. So what we have in effect is the Nasdaq and Russell being the strong ones. So if there is a breakout to the upside, at this stage, if you look at this, the Nasdaq has broken out slightly to the upside, but the ranges have not, the breakout hasn't been all that convincing, and the Russell has not quite broken out of the previous high. So there could be a retracement there. In any event, if I'm going to be a buyer, I will look for a breakout, retest. That's where I'd be looking to be a buyer. And so that's, that's got a couple of, probably at least a week or 10 days to go before that, if that scenario eventuates, I don't have to worry about it for a week to 10 days. On the short side, however, we have an opportunity if it happens this week. So let's have a look at the two charts which are weak, which is the Dow and the S&P. Sorry, let's go back one, and you can see that the Dow tends to be looked to be the weakest of the lot. In this particular case, you can see that it's holding below the 27th of February high. The S&P is actually and holding below the 12th of March high, and the S&P is threatening the 13th of March high. So the S&P is slightly stronger than the Dow, and normally in that situation I would want to be a seller of the weaker instrument. But in this case, because it is the Dow, and I find that the Dow has too much slippage for me, the mini Dow has too much slippage for me, so I would prefer to sell the S&Ps as a general rule. In addition, the S&P is leaning against the previous high, coming in at about 2801. Well, that situation is setting up what I call a repo setup. It's where the market trend is down and we approach a resistance in the next lower time frame, in this case the 18D, and we've pushed through that slightly, and more importantly, you can see how the ranges have contracted, all suggesting that there's a lack of selling. So buying is pushing through because there's a lack of selling. Now if selling comes in, what's going to happen is this is going to have an almighty big day down, and we'll cover those gaps, and we should start seeing then a progression of lower lows and lower highs. So that's what I'm looking for should it occur. So let's have a look at the S&Ps. You can see quite clearly there that where the repo pattern is forming. And now the question then is, how are we going to take advantage of this? Well, we know that the context says we're in a downtrend. It's likely to continue if we get the repo pattern. Where is the entry point for the repo pattern? Now, generally, the entry point is a directional bar acceptance below the primary sell zone, in this case 2770. So if we get a situation where we have a acceptance bar below 2770, that would in fact be the repo trigger. However, and let's take the next chart here, the high is at 2805 at the moment, and even if we assume we don't see a new high today and we do sell below 2770, we're going to be talking 35, 40, 45 pip stop, which is quite a long way away. So the next question then is there a way we can enter the market at a tighter stop and still hope to get the repo benefit? And the answer to that is yes, and that comes in the form of the directional bar on Tuesday. If this is truly a strong bar, and there, you can see there's an open gap there between the close of Wednesday and the open of Tuesday. If this is a truly strong bar, we should not get a break of that low. That low on Thursday should not happen. So that low's coming in at 2781. So if we break below 2781, it would be a sign that the market would then go on to accept below 2770. So that's one way of reducing the size of the stop. But there's another way, and that makes use of what I call the open gap. So what I'm looking for here ideally is for the market probably come off a little bit tonight, make a new high, then come off a little bit tonight. You're not going to see it get down to 2781 tonight, but it'll go part of the way. And then on Tuesday or Wednesday, on Tuesday we get another down day with a close above 2781. On Wednesday we get an open in the day session that is below 2781. So now we have a gap, an open gap between the close, the day session close on Tuesday and the day session open on Wednesday. So we don't want to see on Wednesday 50% of the open gap filled within the first 60 minutes. Then we want to see a break of the range that has taken place so far in the day session on Wednesday. We want to see that broken to the downside, and we want to see that broken by 11 o'clock Eastern Standard Time. So what I would then do is I'd put my stop above the close of Tuesday and be looking for the market to give me a strong directional day closing near its lows on Wednesday. Now that initial stop above the open gap would only be good for Wednesday. I would then look for a place to change that stop. I'd have to move it a little bit higher for Thursday and Friday, because what I want to see by Friday is a directional week, closing below 2770. So if I get that, I'll then move my stop back down to just above the open gap that took place on the Wednesday. So let's do that again. The stop is initially above the open gap, above the Tuesday close. If we do get what I'm wanting to see on Wednesday, I will move my stop up on Thursday and Friday. And if I do get a directional bar closing below 2770 on Friday, I'll bring the stop back to above the close of above the close of Tuesday. So that will tighten my stop again. Now remember that as far in my trading, I do use the rule of 3, which means that my first exit will be twice the stop. I'll take out one third of the position size at twice the stop. My core profit target will be in that primary buy zone, somewhere between 25.40 and about 25.55, 25.60, somewhere in that area. And then I'll be looking to run the last third. You can Google these things in the blog. If you're new to the blog and you're watching this video, I suggest you go to www.tradingsuccess.com blog and just type in the words acceptance, rule of 3 for definitions of these terms. Thanks guys, all the best.